Welcome back to today's personal finance show here on Dublin City FM with me, Paul Merriman from askpaul.ie. And I'm also joined by a really good guest in the studio, David Brady, Director in Spry Finance. David, you're very welcome to the show.
Paul, thanks for having me on.
No problem whatsoever. So David, I said this at the top of the show as well, and in previous talk about press and pensions, people living longer, I have you in to have a chat with us and the listeners in relation to lifetime loans. Can we just start with the basics? Let's go for listeners. What is a lifetime loan?
Yeah, exactly. So a lifetime loan is a mortgage. So it's a lifetime mortgage.
Okay.
But it's a little bit different. And how it's different is the fact that customers borrow based on their age and the value of their home.
Okay. So not their income, which is a traditional mortgage.
Yeah, so it's designed for people, older people in later life.
Okay.
It's designed to recognise that people have reduced income in later life when they retire or coming up to retirement, and to use the value of the home to pay for the loan.
Okay, very good. Okay.
So a customer age 60 and the youngest customer, so if it's a couple, it would be the youngest of the two.
So you have to be over 60 to qualify for this first and foremost.
Both customers have to be over 60, and it starts at 15% for the value of the home at age 60, and one additional percent for every year of age, up to a maximum 40% for 85 and older.
Okay, so if you're 65 years of age, you're going to get 20% of the value of your house.
Exactly.
Okay,
yeah.
so 500k house, you're going to be bringing out €100,000 as a lifetime loan.
Correct.
So you're basically taking the equity out of the house in that example, €100,000. Okay, how do we pay it back? Do we have to pay it back? And what are the options for people?
How do you pay it back? So generally speaking, the most common way is that it's paid from their estate.
Okay.
It's paid for when they go into long-term permanent care, where they leave the house forever. Okay, if it's sitting vacant, it'll be looked to be sold. And that's 12 months after those events.
Okay.
People do service the loans, so people can choose to pay it back anytime they want. It is just a mortgage. So you still own your own home with security of tenure. You can't go into payment arrears. So even if you decide to pay and then you stop,
it's
that's
okay.
no issue. So hugely flexible, and people can pay it. So people often would pay it back, maybe trade down in 10 years. They'll pay back the loan then. And so it's really flexible for that.
That's a really good option. Actually, one of the questions I was saying to you earlier on, one of the questions that came in from a follower on Instagram goes around that kind of downsizing. But I didn't realise you could downsize the home and clear the loan, or you could port the loan over. So can we give people again the example? Let's say I have an €800,000 house. I take a lifetime loan of, let's just say it's €150,000 in this example. And in years to come, I downsize from my 800,000 house in South County Dublin to a two-bed apartment. And a two-bed apartment is €500,000, and I've got 300 grand left in my bank account. I can elect to pay it or elect to transfer it across.
Correct, yeah. So you can do either or. So if you decide to pay it off, there's no charge for that. Okay, so you've got downsizing protection in it. There's no charge for it. And you can, if the customer wanted to port it across or a portion of it across, they can do that as well.
Okay, so I owed 150 and I only want to pay 75,000 off it.
Yeah,
and
so
75k loan on the new house. Yeah,
correct. So depending on where you're at, what you're looking to achieve, your objectives, etc., you can do that.
Okay, brilliant. And in relation to the transfer of the porting across and the two options, is it a case that you see this happening, or is this kind of, if you've got a working example, this already happened? Because I find that people don't. I find when I'm talking to clients from a financial planning point of view and they're in their 40s and we're talking about pension planning, they might say, I can downsize from the house when the kids are growing up. But when I get the clients that are 60 and 70 years of age, they don't want to downsize because they've raised their kids there, their grandkids are now coming. So I think a younger person would automatically default to, I can downsize. But I think those that have lived in the house for 20, 30 years don't want to downsize. So have you seen this really? I know it's a great option to have, but have you seen it in reality?
Yeah, so both are right? So customers 60, 65, 70 don't want to downsize.
They
don't. People generally in very big properties will look to when they get a bit older. But most people of our customers tell us they don't want to downsize.
Yeah.
They like staying where they are, in the community, in their friends, family, local doctors there, all that type of stuff, GP, like that's all important. And then you come around to the real important, like where are they going to downsize to? So, what we find is that people are looking to downsize in terms of property, and they go to look at an apartment, and the apartment is more than the house that they're in.
Yeah. In today's world, that's possible.
Yeah, so it's having suitable accommodation for those people as well. And
I think the biggest thing you touched on there for people in their 60s and 70s, I actually had this with a taxi driver today, actually having a good conversation about financial planning when he picked me up. And he was saying that his neighbour moved, got a big lump of money, obviously the equity out of the house, but they don't like their new they don't know their new neighbour, so they feel really isolated in another house in a different part of Dublin. And that's made him realise that he will never, ever, ever downsize based on that experience. So it's not necessarily about the money or the size of the house. It's that community you've generally built up over 20, 30 years. Hi to the neighbour, you know the kids. I think you can't put a price on that.
You can't. It's somebody's home. So I think when when people are talking about it, they're talking about it as a property and saying in 10 years you can downsize. And it's not as easy as that. It's your home. It's where you live. It's where your family is, your friends. And ultimately, it's what the customers want.
David, can you bring us through Spry Finance then? Because I remember there was a number of different lenders in the marketplace with this product before the financial crash. And a lot of them pulled out of the market because it wasn't viable after the financial crash with values, etc. My experience pre-2007 was that this product was, I'm not going to say missold by people. I'm going to say probably misrepresentative, but by people as in maybe kids of parents themselves, and people didn't really understand how it worked. I think what you guys have done with Spry Finance have been extremely clear, extremely professional. The calculators on your site, all the information on your site, which is obviously spryfinance.ie, is it?
Yeah. Spryfinance.ie, yeah.
For those who want more information. But yeah, bring us through the difference in the product now from where it was in the past.
Yeah, it's a great point because they have evolved, like all mortgages over the last 15 years. But there's a few key features that we think are core features to these products. So one is that all of our loans now are issued with a fixed rate for life.
Okay.
So that's really important. If you're taking out a loan over a period of time, you want to know exactly what it costs. So if you think you're going to have it 10 years, 15 years, wherever it is, you have a fixed rate forever.
So you're not getting a surprise letter in the post by increase in interest rates.
Correct. Okay. So you're locked in. So you understand what that rate is. All of our loans have a no negative equity guarantee. So if you borrow an amount and you live to 110 and there's a property crash, 3 weeks before you pass away, that's our risk, not the customer's risk. And that wasn't there previously from some providers.
Well, the limits there can be the same, because you're mentioning, starting at 15% and 1% more for every year a few minutes ago. I think you could borrow much more back in 2006, 2007, could you? Or is that my imagination?
Other providers maybe gave you a little bit more.
Yeah.
But the problem was the values of the property that they're putting it on was...
overinflated.
Yeah. And that's where the real...
So you've already kind of protected, because let's take a hypothetical situation. Somebody takes 15 or 20% loan to value. Even with the interest rate accruing and growing up in a gross roll-up, it's very unlikely they're going to fall into negative equity. I mean, I'm not going to say impossible, but it's really built to make sure that that's protected, even without your protective mechanism in it.
It's built to design to allow you to trade down in the future if you want it, and for you to have equity in it. We are conservative. Believe it or not, people give out to us because we don't give them enough sometimes. But we think that's right and appropriate too. Like there's an appropriate way into what you should give.
Well, it's learning from past mistakes as well.
Yeah, you got to manage this right. Yeah, and and most people don't take the maximum amount, by the way. So if somebody qualified for 100,000, most people take 80% of it. They take what they need, not what they qualify for.
Okay, now I'd love to touch on this next topic in relation to people that may have loans with alternative lenders. Okay, so I'm going to use an example of Pepper Finance maybe, or what was Mars Capital. So these are people that typically had a tracker mortgage or a variable mortgage with the likes of Permanent TSB, Bank of Scotland, even the likes of AIB, Bank of Ireland, pre-recession. They got themselves into financial difficulty. They went in through, the non-preferred loans, they would have been called. Lenders didn't really want them. They sold them off very cheaply, the likes of Pepper. And in that example, I know I've been getting calls from clients for the last couple of years, really stressed about the level of interest rate they're paying. Some people are now paying over 9% for their interest rate with Pepper. So, and they typically tend to be older people because they would have had more borrowings. Just back in 2006, 2007, they were in their early 50s or maybe late 40s. Now they're over 60, they're coming towards retirement, they still have a mortgage, it might have been interest only, and the rate is now through the roof. You guys can take or port that over. Again, once it's within the lending criteria of the 15, 20, 25%, depending on the age, and reduce the interest in that example, or possibly reduce the interest.
Yeah, exactly. So we would do quite a lot of that, actually. So about a quarter of our lending last year was for those type of purposes. And it's either people looking for a better rate. So as you say, those customers on kind of really, really high rates. Customers who were just considered too old by other lenders. So they may have never missed a payment. They could have been on an interest only, like you said. Bank of Scotland, Ireland would be a big example. A lot of customers there coming across. They're 65, 72, etc. And they need to put their hands on 70 grand. They now don't want to downsize, like you said. So they come back to the realization of, actually, this is my home and I don't want to do it. Can I extend it? And the lender says, no, you can't. Too old. We do a lot of that. And so we've refinanced customers across all the banks and lenders, but we do quite a lot of the kind of credit servicer funds, and it gives them an option. And a lot of those people will service it as well.
Okay.
So again, they're using the kind of the optional payment piece. So look, I can afford to pay $250 a month. That's what I want to pay.
Yeah.
So we can say that's fine.
Yeah.
If they want to reduce it in the future, they can. If they want to increase it, they can.
But as we said, they don't have to. They can just keep it
They
up
don't
and
have
then
to.
the equity. So can we give the listeners maybe a working example? I must say your site is very good, and the calculator there is you can put in what the value of your house is, how much you want to borrow, and it'll give you all the calculations. It'll take the kind of assumed growth rate of your house as well. And you can put that in, whether it's 1, 3 or whatever percent.
Yeah, so you can change it. The
You
customers
can change it.
yeah.
Because so again, you're not trying to mislead or trying to tell people hypothetically you got 6% growth. So you put it at 3%. So let's run a quick example if that's okay. Can you bring listeners through an example of a value, what you borrow, how much you have to pay back, what the interest rate is, and what you probably end up paying back in whatever amount of years?
Yeah, so say we take a value of €500,000 home and they qualify for 20%. So in that case, it's 65-year-old. So they're taking €100,000. That's the maximum they can borrow from us. And let's say the customer borrows the maximum amount, and it's refinancing an existing mortgage, for example. We would take a first ranking.
Or sorry, they're just spending it, because you can just do that. You could take this to have additional cash flow.
Yeah, and it can be, and most people use it for a combination of things. It's not just for one thing. So maybe it's refinancing a loan, part of it. Maybe it's doing some bit of renovations of the home. Maybe it's, giving a bit of a living inheritance to the kids. It's et cetera, et cetera. So if the customer chooses to make a payment, they can choose the amount. They can choose the frequency. They can do it monthly, easy on a direct debit. They can pay it annually if they want. Really flexible. So there's no.
So this is just the interest. On that example, if you're just paying a direct debit and you want to clear the interest off the loan, it's not capital interest. It can just the interest.
It's just the interest.
Okay,
you can pay the interest only.
Let's take an interest rate. Assume the interest rate of whenever it is on a yearly basis.
Starts from 6.5%.
Okay, 6.5%. You're going to pay that off on a yearly basis, around $6,500, and you do that every year. And then let's say you pass away in your 90s. You still only owe €100,000, but the property is probably worth 7, 8 or 900,000 euro, depending on the growth.
Correct. And then if that same customer decided, you know what, I don't want to make the payments, I want to keep the €500 in my pocket every month, that loan would double in about 11 years.
Okay, so your 100,000 is now 200,000 outstanding.
Correct.
Yeah, so if you die then, and you have your 500,000, should hopefully have gone up to whatever, 550, 600,000 maybe. Yes, so you're nearly borrowing off the future growth, if there's growth, but you can't back that.
Exactly. So like nobody knows what house prices are going to happen to, right? So all you can do is look over a period of time. Like we've been around lending since 2006. So if we look at our back book customers, which is a good kind of example, right? So they've been right through the cycle. The average loan to value in our back book is 50%.
Yeah.
And they've had the loans, 18 years. So obviously, and that's been through a peak and a trough and everything in between. But it's about, and that's why it's really important. And obviously, we know stuff that comes through your company about people getting financial advice and understanding where they are, what they have, what the future is going to look like. Be conservative enough, not being too bullish on. Yeah. Oh, we think it's going to, 5% growth a year or things like that.
There's no need to be that bullish. I think you're right. Pulling it down to 2 and 3%, and with anything above is nearly a bonus. Okay, so let's talk about the product in a little bit more detail, how impactful it can make people's lives. I'm going to talk about it from a positive point of view. As a financial planner, people need cash flow. People want to retire earlier. They get to retirement, they haven't built a big enough pension fund, and it could be through a reason of cash flow during their life, or they might have been sick, or whatever reason is. And they end up in a situation where they have no loan or small loan outstanding with a bank. They can use this product to bring in cash flow. So in that case, if you have a 500,000 value of a house, you now have €100,000 you can take out. I think, personally speaking, you're better off doing that and having that 100,000 to spend and enjoy retirement in between 60 and 65 or 75, whatever it is. I don't believe necessarily, and I'm sorry to any kids out there that might get a bit annoyed by this statement, but I don't think it should be fully left. I don't think the idea of a couple or someone who's single and might have been single all along, or their partner or spouse has passed away, don't believe in those people being cash strapped in retirement age so they can give a bigger inheritance down to their children. That's just me personally, and not everyone will go with that, but that's me personally. So I think taking the full kind of lifetime loan, the maximum you can get, and having a good retirement is a really, really, really good idea, because it's a cash flow. Where I see this sometimes going wrong, David, I've had this instance in Ask Paul where people have DM'd me and they're saying, my mum and dad have a house, there's no mortgage on, I need a deposit for another house, can they take a loan and lend it to me? And in theory, there's nothing wrong if that happens, but I always like to feel more comfortable as a financial planner when the conversation starts with the parents asking me, can they help their child in that way, and not the reverse, because I think sometimes the reverse, the parents could then feel under pressure I think that's where this will fall down for people listening today. I always want to see it coming from the parents' point of view.
Yeah, 100%. And I suppose that's, one of our that's our main focus when we meet our customers. So we know how much you can borrow when you come in. We know your age. We have a rough idea of your house. It's about making sure it's suitable and what you're looking to achieve out of it. And looking for things like that is important. And we often will get those calls as well. And what we definitely say is that you're not the customer.
Yes.
So we
can't
really
even talk to
you. You're not the customer. So we can give you some information around it, but actually your parents are the customer and we'll be talking to your parents.
Yeah. I would say to listeners, if you are someone that is over 60 years of age and from a cash flow planning or a lack of pension planning, there really is no point in being cash strapped and having all the equity or all the value in an asset that's not generating anything for you. I think this is a really, really, really good option. That's not just to push the product for Spry. I've always believed this. As a financial planner, you need cash flow and you need to be able to enjoy your life. It's really important you have money there to enjoy, especially when you get to that age bracket where you might want to be travelling, especially when you're maybe still healthy, if you're still healthy and in good nick, because it is important to go out. David, is there any products that you don't look at? Is there any properties? What's the rule of thumb here?
So at the moment, ours are all around family homes.
Okay.
So it's their family home is what the product is based on.
Okay.
We are looking at some innovation around that. So we are looking at kind of second homes because often people would kind of say, look, we have the house in Dublin, but we also have a place in Galway, or
as in a holiday home, then more or less.
As like a second home. And then we have it the other way around, where you might have a customer who's living in Cork, but they have an apartment in Dublin for kids going to college. They need to get some work done on it, etc. And they're looking for a lifetime loan on that type of property. And then we're going to look at a kind of a buy to let as well, hopefully in the next couple of weeks as well. So they'd come out. But primarily at the moment, it's all on family homes.
Okay, very good.
So it's a very much a consumer product. We don't do commercial or anything like that.
Okay. But again, from the family home point of view, I think it is important. One of the questions, and I'm going to get a bit ahead of myself here, but questions which will actually stay around for a couple of seconds. But one of the questions was in relation to bringing the kids in. So should people bring their children into the conversation if they are going to do this? I think they should. Would your advice be the same?
Yeah, so we're very big on that. So kind of open and honest communication. So we advise customers to talk to their family and friends about it. We advise them to get independent financial advice if they haven't come through that channel already. But we do insist to get legal advice as well. That's part of the process because they entering a contract,
yes,
a mortgage contract, so they have to have independent legal advice. But informing the friends and family is just good overall, better communication, frankly.
Yeah, it is communication.
You don't have to do it, right? So, I've said it before to somebody who kind of looked at me as if I had two heads, and he said, well, I have a 22-year-old and he's out in, not too far from these studios 3 nights a week in town. I'm not discussing my financial affairs with them.
That is fair enough, in fairness. It does depend on the child. I would typically, in my head, envisage your kids that you're going to have discussion with, having their own kids maybe, or being in 30 to 40 years of age, well set up and able to have this conversation with it. And you don't. The reason why the conversation should be had, in my opinion, is you don't want to have a shock at the end, because unfortunately, people, when they do look at their parents' assets at a certain age, they, not saying they bank on the money coming in, but they will think, I'm going to inherit X or Y. And that's very normal when I'm talking to people. And if there's a 200,000 outstanding or 300,000 liability outstanding they not know about, it can sometimes leave, I'm not going to say bad taste, but it is important to be upfront, I think.
Yeah, it's a shock, right? So it's just about communication, and people get to manage it and they plan around it.
Okay, lastly, before I let you go, in relation to the likes of the Fair Deal scheme, and if somebody does need to go into long-term provision, how does this loan sit, or where does it sit?
It works alongside it.
Okay.
So we're, again, as just a mortgage provider, so we'll have the first ranking charge. The Fair Deal take a second ranking charge on it. So it's our policy that it automatically happens.
So the Fair Deal won't say you can't use the Fair Deal because I have heard people saying you can't get a lifetime loan because, or if the Fair Deal won't deal with you if you have an outstanding lifetime loan. That's untrue.
That's not true. Right. No, that's not true.
That's a good myth to bust, I suppose.
Yeah, no, it's not true at all. Like we would grant that on a weekly basis at this stage, because we have people from 2006. So, we've lots of those kind of code cases coming through. It sits alongside it.
Okay, brilliant. Okay, so what age do we need to be to apply for a lifetime loan? And that comes in from Tom. We've mentioned this in the previous piece. Let's run through it again.
Yeah, so it's the youngest person has to be 60, and if it's in a couple, it's the youngest.
Okay.
So if there was a couple and the wife was 62 and the husband was 58, they wouldn't qualify. The youngest person has to be 60.
Okay, perfect. That's not a reason to divorce your 58-year-old wife in that example, just to get a lifetime loan. My husband passed away in 2022. Can I apply for a lifetime equity release? And that's from Jacqueline. Jacqueline, sorry to hear that. But yes, sorry, I'll answer this. You can. You don't have to be a couple.
Yeah, no, you can't. You
can
absolutely
be widow or widowed.
Absolutely,
Or just single. Okay. Can I make payments on a lifetime loan, or does it always gross roll up? Again, we covered this, but again, let's go through this again for Derek, if you don't mind.
Yeah, you can. So a lifetime loan has optional payments. They're not contracted payments like a standard mortgage. And because they're optional, customers can choose to pay anywhere up to 10% of the original loan balance that they borrowed each year. They can start paying, they can stop paying, they can start again, they can amend the amount. It's really flexible. So it helps them manage the loan balance over time if they wish to pay it.
Okay, brilliant. Actually, next question. These are all pretty much what we did cover, but these are the questions that people are asking. And so maybe people hopping in and out this morning. So what happens if I sell my house before I die and I have a lifetime loan? So this is the porting option or just clearing the mortgage option, is it? Or the loan option?
Yeah, so this is the case if they sell it. So that's the kind of, we presume that they're going somewhere else. So they might be downsizing and they have downsize protection. There's no cost to that. They just repay the loan, the balance gets cleared, and that's it.
Okay, great. David, again, thanks for coming to the studio. For listeners, remember you can get involved in the show by asking a personal finance question show on my Instagram page, askpaul.ie, every week. If you're not on Instagram, you can WhatsApp us here in the studio at Dublin City FM on 087 179 1032.